The 1.2 trillion paper debt bubble has burst. Where are U.S. stocks headed? U.S. stock market outlook after the Trump XE summit, MSF, NVA, Tesla. The bond market is the biggest threat to U.S. stocks. Wall Street has already begun to fear it. Follow me, and we will keep watching the market together, not chasing emotion, but breaking down the logic. Don't forget to like, share, and bookmark. Everyone, today the U.S. stock market feels a little off. On the surface, the market is still talking about AI, NVIDIA's earnings, Microsoft's cloud business, and whether Tesla is returning to its growth stock narrative. But what is really making Wall Street nervous underneath is not one company dropping a few percentage points, but the bond market starting to show its teeth. What does that mean? For the past 2 years, the market has believed one story. As long as AI keeps growing, as long as big tech keeps spending, and as long as NVIDIA keeps selling GPUs, US, stocks can keep moving higher. But now, the bond market is reminding everyone, money is not free. Debt is not costless. And AI cannot be financed forever on storytelling alone. According to data compiled by M&G Investments, by October 2025, AI-related debt had expanded to about $1.2 trillion, becoming one of the largest segments in the investment-grade bond market, and accounting for about 14% of the high-grade bond market. This is what today's title refers to as the $1.2 trillion paper debt bubble. To be clear, I am not saying this entire $1.2 trillion has already blown up, nor am I saying AI companies are about to default immediately. The real issue is this. When AI shifts from being a dream in the stock market to a financing demand in the bond market, it is no longer just a technology story. It becomes an interest rate story, a cash flow story, and an energy story. And once bond yields continue moving higher, Wall Street's favorite high valuation assets, including NVDA, MSFT, and TSLA, will start to be repriced. So in today's episode, we are not going to talk in slogans. We are going to break down 3 questions. First, why has the bond market suddenly started pressuring U.S. stocks? Second, after the Trump X summit, why did the market not truly breathe a sigh of relief? Third, NVIDIA earnings coming. How should we look at MSFDA and Tesla? Here's the conclusion first. The U.S. stock bull market is not necessarily over, but it is moving from the stage where stories alone can push stocks higher into the stage where only those that can deliver cash flow will survive. Let's start with the first main thread. The bond market is starting to put pressure on stocks. Last Friday, U.S. stocks pulled back from near record highs. AP reported that the S&P 500 fell 1.2% from the record high it had set the previous day. The Dow Jones dropped 537 points, and the Nasdaq fell 1.5%. Technology stocks were the main source of pressure, with NVIDIA falling 4.4% that day and becoming one of the biggest drags on the S&P 500. This was not just an ordinary technical pullback. Behind it was a bigger reason. Oil prices, inflation, and bond yields had returned to the center of the market. Kiplinger cited Interactive Brokers senior economist Jose Torres as saying that the bond market was seeing a bear steepening rise in yields because global price pressures were overheating and investors were raising their inflation expectations. In other words, the market is not worried that the economy will collapse immediately. It is worried that inflation will not come down, making it harder for the Federal Reserve to cut rates while long-term bond yields keep pushing higher. This is extremely painful for technology stocks. Why? Because technology stocks, especially AI technology stocks, are valued based on cash flows many years into the future. The higher interest rates are, the less valuable those future cash flows become when discounted back to today. Once bond yields rise, the market starts asking a very practical question. No matter how attractive your AI story is, can it make money right now? No matter how massive your data center plan is, when will the cash flow come back? No matter how hot your GPUs are, has the stock price already reflected it in advance? That is why when the bond market moves, technology stocks feel the pain first. The second main thread is that after the Trump-Xi summit ended, the market did not get the answer it wanted. Before the summit, AP had already noted that expectations for a major breakthrough in long-running U.S. China tensions were low, with issues including trade, Taiwan, and Iran. After the summit, Fortune's headline was very direct. Wall Street saw Trump's China trade outcome as having no real substance and global stocks sold off. The report said that after Trump returned from China, he offered few details on concrete outcomes. Major Asian and European stock indexes broadly fell, while oil prices stayed elevated and bond markets also came under pressure. This is the key point. What did the market originally want? The market wanted a clear signal of easing tensions. For example, lower tariffs. For example, looser chip export controls. For example, relief from energy shocks. For example, a halt to the continued mutual choking of supply chains between the US and China. But what was the result? The result was that there was stability in words, but traders did not see enough concrete details. This matters a lot for NVDA, MSFT, and TSLA. NVIDIA is worried about export restrictions and uncertainty around Chinese demand. Microsoft is worried about AI capital expenditure becoming heavier while the return cycle stretches longer. Tesla is worried about simultaneous disruptions from the Chinese market, tariffs, supply chains, and consumer demand. So the end of the summit does not mean the risks are gone. More accurately, the market has shifted from expecting good news to checking the details. And as long as the details are not enough, some capital will step back first. Now let's talk about the third main thread, NVIDIA's earnings. According to next earnings date, NVIDIA's next earnings report is scheduled for after the market close on the 20th of May, 2026, covering Q1 FY2027. The market expects revenue of about $78.93 billion and earnings per share of about $1.76. Why is this earnings report important? Because in today's US stock market, NVIDIA is not just one company. It is more like the thermometer for the entire AI trade. If NVIDIA's earnings explode again, it would show that AI capital spending has not cooled and data center demand is still strong, which could push tech stocks higher again. But if NVIDIA merely meets expectations, or if its guidance is even slightly conservative, then problems may emerge, because NVIDIA's previous quarter was already extremely strong. According to the company's official earnings report, NVIDIA's quarterly revenue for the period ended the 25th of January. 2026 was $68.1 billion, up 73% year over year. Full fiscal year 2026 revenue was $215.9 billion, up 65%. Its gross margin also remained very high, with quarterly GAAP gross margin reaching 75%. What does this mean? It means the market's requirement for NVIDIA is no longer good, it has to be extremely good. It is not just growth, it has to be continued growth above expectations. It is not just AI demand still exists, AI demand has to be even stronger than the market imagines. This is the most difficult part for high valuation stocks. Excellent results are not enough. You have to be even better than excellent again and again. Next, let's look at MSFT, NVDA, and TSLA one by one. First, MSFT, Microsoft. Microsoft is now one of the most stable companies in the AI era, but also one of the most debated. According to Microsoft's official FY2026 third quarter earnings call information, Microsoft Cloud revenue reached $54.5 billion, up 29% year over year. Azure and other cloud services revenue grew 40%, or 39% in constant currency. This data is very strong. But why is the market still conflicted about Microsoft? Because Microsoft's problem is not a lack of growth. It is that AI investment is becoming extremely heavy. Investors now watch Microsoft not only to see how much Azure grows, but also to see how much it has to spend on AI, data centers, chips, memory, and servers. If the AI business can turn this capital expenditure into stable profits, Microsoft is a winner. But if spending keeps accelerating and returns do not come fast enough, the market will pressure its valuation. So the key phrase for MSFT going forward is cash flow delivery. Microsoft is not a bad company, it is a top-tier company. But even top-tier companies can face valuation pressure. Especially when bond yields rise, the market becomes more demanding. When will the money you spent come back? Now let's talk about NVDA, NVIDIA. NVIDIA is the core asset of this AI bull market, but it is also one of the stocks most likely to trigger market volatility. The key question now is not whether it can make money, but whether it can keep beating expectations. NVIDIA's last quarter revenue was $68.1 billion, and full-year revenue was $215.9 billion. That scale is already extraordinary. But when a company becomes the most crowded AI trade in the entire market, its earnings report is no longer just a company report. It becomes a test of market faith. There are three key points to watch in week's earnings. First, whether data center revenue can continue growing rapidly. Second, whether there is strong new guidance on the Blackwell and Rubin product roadmap and supply situation. Third, whether management's description of the AI capital expenditure cycle remains aggressive or starts to become cautious. If NVIDIA continues to give strong guidance, US tech stocks may recover in the short term. But if NVIDIA's guidance is not impressive enough, the market may punish valuations because the good news is not good enough. So it is not that NVIDIA cannot be viewed positively now, it is that you cannot analyze it with the logic of an ordinary stock. It has already become one of the most crowded core positions in the market consensus. Finally, let's talk about TSLA, Tesla. Tesla is in a rather delicate position right now. It is an electric vehicle company, an AI narrative company, and a robotics narrative company at the same time. The problem is that the market's patience for long-term stories is declining. According to Yahoo Finance, Tesla's Q1 2026 revenue was about $22.39 billion, up 16% year over year. And net income was $477 million, higher than $409 million in the same period last year. Electrek also noted that Tesla's Q1 non-GAAP EPS was $0.41, with revenue of about $22.38 billion. The numbers are not bad. But Tesla's real problem is that there is too much future embedded in its valuation. FSD, Robotaxi, Optimus, and the energy business are all future stories. As long as interest rates are low and liquidity is strong, the market is willing to pay a high price for the future. But once bond yields rise, the market will ask, can your car business continue growing? Can your gross margin hold up? When will your AI and robotics businesses enter the income statement? When will your story turn into cash? So the key phrase for TSLA going forward is narrative delivery. If it can prove that it is not just a car company, but an AI and robotics platform, its valuation can still hold. But if the market starts valuing it only as an automaker, the volatility could be very large. So how should we look at the US stock market from here? I think there are three key things to watch next. First, watch bond yields. If long-term yields continue rising, technology stock valuations will remain under pressure. Especially companies whose valuations depend on future cash flows will be hit repeatedly. Second, watch NVIDIA's earnings. Next week, NVIDIA will be one of the most important events in the market. Its earnings will not only affect NVIDIA itself, but the entire AI chain, including semiconductors, servers, memory, power, cloud computing, and even AI software and cloud giants like MSFT. Third, watch whether capital rotates from semiconductors into software. Recently, there has been an interesting signal in the market. The market ear cited JP Morgan's view that short squeeze risk in the software sector has risen to its highest percentile in the past 6 years, while semiconductor positioning remains crowded. In plain language, everyone is crowded into AI hardware, while software has been neglected for too long. Once semiconductors start pulling back, capital may look for relatively cheaper and under-owned software stocks. Whether this is good or bad for MSFT depends on how you look at it. If capital rotates into high-quality software, Microsoft may benefit. But if the market worries that AI capital expenditure will drag on profits, Microsoft may continue to be pressured. So, to summarize, the US stock market right now is not simply about up or down. The real Maris spots in the US stock market. In the past, AI was a growth story. Now AI has become a financing story. Now AI has become a financing story. Going forward, AI must become a cash flow story. The $1.2 trillion of AI-related debt is not necessarily a bomb that will explode immediately. But it reminds us that AI is not magic floating in the cloud. Behind it are bonds, interest rates, energy, chips, data centers, and real capital expenditure. The Trump-Xi summit did not give the market a sufficiently clear signal of easing. Bond yields continue to pressure technology stocks, and NVIDIA's earnings next week will become the key judge of the short-term direction for US stocks. My view is very direct. For MSFT, watch cash flow delivery. For NVIDIA, watch whether earnings guidance can continue to impress. For TSLA, watch whether its future narrative can land in the income statement. US stocks may still see short-term rebounds, but from now on, you cannot just watch the story. You have to watch the bond market's mood. Because when the bond market starts showing its teeth, the stock market cannot completely pretend it does not see it. Finally, a reminder. Today's content is for market analysis only and does not constitute investment advice. Market volatility is high, especially in high volatility stocks like NVDA and TSLA. So both chasing rallies and buying dips require discipline. What do you think? Do you think NVIDIA's earnings week will save us stocks, or will they become a stress test for the AI trade? You can type "save the market" or pull back in the comments. Type "save the market" if you think NVIDIA can still lead technology stocks higher. Type "pull back." If you think pressure from the bond market is not over yet, and US stocks still need to digest valuations, and if Nvidia misses expectations, where are the most dangerous spots in the US stock market? Follow me, and we will keep watching the market together. Not chasing emotion, but breaking down the logic.